Hey there, Joe DiSanto here, broadcasting live to you from my car. Yep, I'm on a road trip right now, and got a driving day here, so I'm gonna make some videos. Why not? Might as well make videos while I drive. I'm gonna keep my eyes forward though most of the time. Okay, so in this video, I'm gonna talk a little bit about risk in investing, and as the video, title said, you do need to be quote unquote risky in investing, but let's talk about what that means. Controlled risk. But first off, let's talk about risk tolerance. So what is risk in investing? Often you hear more risk, more reward, and that general thought does play a part in your thinking here. But risk tolerance is essentially your tolerance for losing money. And it's a funny question because anytime anyone ever asks me that, I'd be like, I have no tolerance for losing money at all. So I don't know why we'd ask such a dumb question. But the truth is, I guess the way I phrase the question nowadays is like, what is your willingness and or ability to keep working if you experience a sharp and or prolonged market downturn? And that's a real question. That's the risk tolerance. Do you have time to make it back or wait for your investments to come back if there's a long downturn? And they happen. 2008, 2020, we just had a pretty, sharp one that lasted about a year. If you were in crypto, we're still in a crap downturn. So if you're young, obviously you have more time to keep investing and also dollar cost average into lower times, and have your money find its way back. If you're in your 60s, or early 70s and you're about to retire, well, your risk tolerance is low because literally you don't want to work, but you might not even be able to work, right? So when you're young, you definitely need to take risks to improve your potential return. And when you're old, you want to de-risk and protect capital. So what are the range of investments that may be risky or not risky? Well, a savings account is the least risky, in theory. The money's not invested, you're getting a interest rate on your money, and you have no risk of capital, and or US Treasuries is essentially a riskless investment in terms of risk to capital. So that's, those are examples of no risk. And then the highest risk would be, buying like the latest meme coin and just dropping all your life savings on that and hoping that it works out. That's incredibly risky. Well, we never go to that extreme risk. Stay away from meme coins. So ultimately, when you're young, you're more risk on, and in the normal world outside of crypto, that would be an all-stock portfolio. You might even consider just the S&P 500 ETF or an all-stock ETF from Vanguard. That, believe it or not, is a higher risk way to invest. And I'll give you a good example. If you were about to retire in 2008, say, and you had all your money in the S&P 500, which I think a lot of people generally feel is low risk, and in the long run probably is, your money would have been worth about half, maybe even a little bit less, by the end of 2008. And you might be putting off retirement. So, when you get in and when you get out, obviously makes a big difference, but an all-stock portfolio at that time of your life is actually quite risky. Now, the conundrum there is, as you get into retirement, you want your money to make as much money for you as possible. You don't want to just spend the money that you have. So you're like, well, now I got to go into investments that make very little return. That is another question and something that can be debated, and it's definitely a conundrum for the later years of life. But putting that aside, the all-stock portfolio when you're young is probably the way to go. And if you want to go even riskier, you might be going into high growth tech stocks, for example, or AI stocks or whatever. Sometimes you're investing in stocks for the company doesn't even make a profit yet, but the idea is that they have a great product, or they're so innovative that when things take off, it's going to be gangbusters. Now, it's hard to invest just in single stocks and know what you're doing unless you're going to devote a significant amount of your time to it. So I tend not to generally recommend that to people. I would tend to say just go with a ETF stock portfolio, but more return can be achieved by cherry picking stocks. And then outside of stocks, of course, there's real estate, there's alternatives, there's all sorts of things you can invest in. I'm going to wrap up the video by just giving you some goal, compound annual growth expectations. The all-stock S&P 500 investment has generally returned about 10% compound annual growth over the last, 100 years with reinvested dividends. People tend to use that as a good benchmark. So if you can dig out 15%, 20%, you're going to see your net worth, really exponentially grow by taking the time to get that extra return. But by going for that bigger return, you take more risk on often. The goal with many investment advisors and anyone who's selling anything is to say, we get you a superior return with less risk. That's the unicorn that we're all after, right? But generally speaking, your returns are going to be somewhere in the 2 to 12% in the normal person. You're not doing anything crazy or unique range, and the lower 2-3%, your average savings account, no risk, and the 10-12 all stock portfolio, much higher risk, and the extremity of risk can go up from there, of course. I got another video somewhere on the YouTube about the spectrum of risk, and I put it in a little bit of chart form, so take a look for that if you want some more info on this topic. All right, see you later.